How's it going, Michael? How's it going, Leon?
Going very well. Thank you.
How you doing, Anand?
Doing well, Michael. How are you?
Good. I think this music might be a bit loud. There we go. You have more hair. You look different, hair-wise.
Kind of.
Kind of.
I
Okay.
have more. I have less than I did before, but more than I did when I got a haircut. So it's kind of
Okay. Are you guys back in the office yet?
No, Contra Costa passed new, or they pushed out the new mask and indoor rules. So we're still in training for some of the new hires, but we're still very much at home.
Yeah. You know, I'm still wearing my mask when I go inside, so they didn't have to tell me. But once I heard about all those variants, do you remember Brahim?
Yeah.
He and a couple of his buddies went to Florida last week. They went down to Miami, and they were all vaccinated, man. And he brought it back.
Yikes. Yikes.
All I can say is yikes.
Yeah, that's a yikes moment for sure.
I'm like, dude, what were you thinking? You knew where you were going.
The people that I know in the medical profession that are dealing with areas that are unvaccinated, they're basically sending, if you come in and say you have symptoms and you've been vaccinated, they'll send you home.
Because it's not killing you.
Because
I mean,
he
had a rough time, but I'd rather have a rough couple of days than be there with a damn ventilator.
Yeah, exactly.
I'm still trying to stay away from it, man.
I think we all are.
Good.
Leon, I haven't seen the email from Emily yet. Do I need to check?
Email from who?
Emily, for the slides.
Oh, Leon, are you listening?
Yes. It should be. Did I spell it correctly? 1 second, please.
Did you go to my Street Smarts email or my work email?
Street Smarts.
Okay, let me check that one. That's probably.
If you really want him to get it, send it to him.
Wait, I believe I lied.
You're up.
It's to the Penserra one.
Of course, now my Gmail wants to be a problem too. There we go.
Leon, I'm assuming that we can be heard by the people that are here already, right?
Yes.
Okay. Well, welcome those of you that are here already, and we will be getting started promptly at 6 o'clock.
Yeah, I know, Leon. I'm only seeing the ones I sent you guys. I'm not seeing the
All right. Give me a second. I'll do it myself then.
All right.
Good morning. You're saying good morning, so you must be halfway across the world. Oh, from Iraq. Oh my goodness. Wow.
All right, got it. Thank you, Leon. I am downloading it now.
Awesome.
You guys ever have those moments where you're wondering why you're not as tech savvy as you normally are? I'm having that right now. Why will this not open in full screen?
Won't open?
Not in full screen for some reason. I'm not sure what I did there.
Is it in PowerPoint or is it in slides?
It's in a PDF. I know why. It was in a cloud folder. Alrighty. Okay, I think we're good. I have everything on my side now.
Okay. Just want to let everybody know we'll be starting in 2 minutes. It is now 6 o'clock, and I would like to welcome everyone to the second annual Summer Finance Program. My name is Michael Campbell, and I am the founder and CEO of the Street Smarts. And this production that you guys are going to be seeing over the next month is being put together by the junior board of the Street Smarts and also of Wall Street Bound, which you guys will be hearing about later on. But I first want to thank everyone for signing up and participating in this year's Summer Finance Program. By the end of the month, those who complete the homework and join our live presentations will receive a certified and signed certificate that will be attributed to their resume and professional portfolio. A little background, the Street Smarts was founded in 2017 with the intention of helping students find communities, mentors, internships, and educational experiences to better, to better prepare them for the financial industry. Since then, we have grown at an extremely fast pace, partnering with a multitude of financial firms in California and New York. I have a request. If you have not already gone to the Street Smarts LinkedIn page, please go and become a follower. That's really important. We're trying to reach 1,000, okay? And I think we're sitting at about 601, which is still a long ways from beginning of last year when we had 200. So we're definitely moving along. Before I introduce our speaker, I would like to just throw a shout out to some of our partners for their contributions, both financially and also volunteering and all of the above. And I would like to first thank Penserra Securities for supporting us for the 4th year in a row. Such great people over there. And Anand, who's our speaker, is also from there, so he can tell you more about Penserra. I'd also like to thank Kingsford Capital. They've been with us since the very, very beginning. I also want to thank one of our new partners, and that is Deloitte, because we have expanded into accounting, and Deloitte is now a strategic partner of ours. I'd also like to send a shout out to Bivium Capital, and would like to send a shout out to Jackson Square Partners. So today, our speaker is Anand Desai, and he'll be discussing portfolio management and his experiences at Penserra. Before we begin, I would like to encourage all of you to prepare to ask questions under the Q&A. If there's something we're not understanding about the if there's something you're not understanding about the presentation, sorry. At the very end, please post any questions not related to the presentation, where Anand will also answer them. So I just want to thank you and let you know that the next presentation, I believe, will be on Friday, okay? So thank you, and take it away, Anand.
All right, let me set this up so I can share this accordingly. So share that screen. All right, and then let's put that in read mode. And then let's bring my notes all the way over here. All right, can you guys see everything, Michael?
Yes.
Okay, perfect. So first off, I just want to say thank you to the Street Smarts and the Junior Board for inviting me to speak today. You know, I've been part of the Street Smarts now for, call it 4 years, 4 or 5 years.
4 years.
Yeah, and I've watched it start from Michael and I chatting in a conference room to what it is now. And you know, it's one thing to have a career, but it's also another thing to see other people progress in their careers. And so being part of the Street Smarts has helped me see that in a very, what I'll say, very fruitful way, watching some students who didn't really know what they wanted to do become, you know, full-on financial services professionals, whatever range of people that is. So it's been very rewarding, and I want to just say thanks to the group for inviting me to speak.
Thank you, Anand, for coming.
Absolutely. And just from a high level, so I've got an agenda out here. You know, I'm going to give an introduction, a little bit about myself, talk about Penserra and what I do for a living, which is ETF sub-advisory, a little bit about how ETFs work, and then kind of a more day in the life of ETFs, why they're popular, why they are gaining traction in the industry, that whole question that everybody's been asking, and then kind of understanding why what the difference is between an ETF portfolio manager and a hedge fund manager or something along those lines. So starting from the top, I will give you guys a brief breakdown of my personal journey and kind of where that started from. So just about myself, I work at Penserra Capital. I'm senior vice president and portfolio manager. I've been there for about 5 years. I also am the chairperson of our foundation, and I'm a board member of the Street Smarts. I'm a native of the Bay Area. I was born and raised in San Jose. I went to Davis for my undergrad degree, got a degree in 2011 from Davis in managerial economics. And then, prior to college, I worked a couple of different jobs in different places. Worked at JCPenney, worked for SAT Proctor, worked at a coffee shop in Davis, interned at a big tech company, kind of bounced around in all those places. But financial services was where I kind of saw myself getting into finance. And I can honestly say that it was a blessing in disguise to have landed a job out of college in Sacramento at State Street. I didn't know what I was signing up for initially. And 10 years down the road, it's been a journey of information, knowledge, and absorption that I say, you can't really quantify it, but it's there. And so one of the bigger things, from graduating in 2011 and starting at State Street, my career started in fund accounting. I was servicing one of the top 3 asset managers. At the time, they had about 4 trillion in assets. Now they're pushing 9, so I'll let you figure out who it is. In that job function as a fund accountant, you really are doing mutual fund accounting. What that means is processing trades, processing income, processing accruals in funds, across multiple different asset types, equities, fixed incomes, derivatives, across the board, really understanding how the accounting changes in a fund. Now, what does that mean in the grand scheme? That's the performance. That is going to be what actually impacts the fund's performance at an aggregate level. And that being said, what goes into that is the ability to learn how to reconcile trading activity, calculating income on a fixed income bond, understanding how a mortgage-backed security runs, understanding the different types of options that exist, whether they're calls and puts for equities, whether they're foreign currency options, whether they're options on futures. The scale gets wider and wider. So it's important to just keep absorbing and keep building that information, I guess, pile of information that you have. And that was kind of what I did for the first 2 years at State Street. After the first 2 years, I was promoted to senior associate, started managing NAV delivery. So what are NAVs? NAV stands for net asset value, and that is the value at which one share of a mutual fund is priced. And that's a daily process that's done every day. Why does it matter? From a portfolio management perspective, when you're running ETFs or mutual funds that have an index, your daily valuation process needs to tie versus an index. So you are theoretically index matching an index. You're running a portfolio that tracks that index. So what goes into that? The pieces that go into valuing a fund are going to be prices. Prices across all asset types and across all currencies. Then you're going to be looking at FX variations, because when foreign exchange is brought into the equation, you now have to bring that portfolio back to a base currency. The ones that I normally manage are USD, but that can change depending on where the assets are traded or where the fund itself is traded. But for the most part, we're bringing all these assets back to USD. So you're bringing in what's considered a international portfolio across maybe 10, 15 different markets and countries, all back into one USD-based currency and valuing it. So that whole process, that ends up becoming, not only is it done in a shortened time window, but it's also done with a level of high risk, efficiency, and you're just stacking up all these time constraints on top of it. So that's kind of where the senior associate role for me was, and that's kind of where it developed into, taking on some higher risk things like liquidations of accounts, transferring clients from one account to another, things like that that are high risk and they need to be done at a certain level. Employee needs to do it that has the experience in all the other asset types. Like I said, it's very full circle and very building that information pile that you have. And then my last role at State Street was within the client operations team, and that running that whole team, which was basically keeping track of, as a unit, this client needs all these NAVs at the end of the day at a certain time, and working with all the other teams that are out there to make sure that we are meeting those deadlines. Like I said, again, full circle. So I guess I'll move to the next part now, which is the years at Penserra, and kind of try to explain why this move happened. So it really was a calculated career risk. It was one of those items. It was one of those things that when I decided I wanted to be a portfolio manager, I was willing to do it, and I was willing to take the move to Penserra, which is a smaller shop, not a large asset manager, and not a power player in the ETF space or anything like that. But I was willing to do it because a lot of the senior managers that I had at State Street knew senior managers at Penserra and recommended that I go. They said it would be a good career move for me to do it, which is why I'll give you that advice now. Networking is key in this industry. It's too small and it never ends. So just something to keep in your minds and think about. So within that, the associate level as a junior PM, now the information that I had learned through the first 5 years of my career, it never went away. In theory, the job function as a portfolio manager is very similar to the job function as a fund accountant, except that you're checking it the opposite way. The accounting team is going to have an accounting book of record, and they're comparing it against what the portfolio manager has, which is an investment book of record. As the portfolio manager, I'm doing that same reconciliation backwards now. I am the investment book, and I'm reviewing against the accounting book. That's another. So that reconciliation just basically got flipped around. That's still part of my daily processing, daily part of my checks, and it has to do with fund performance. If these positions don't tie out, if the weights versus the index don't tie out, if there's a corporate action in the fund that happened that was not accounted for, these are going to create performance differences versus the index. So that's something that we're constantly looking at and we're constantly keeping track of, because not only do we have to do that, but we also have to be able to prove it, from a reporting perspective to board members, to the board of the fund, and all those people that require it. So from that, as an ETF portfolio manager, you're tracking index changes, you're tracking corporate actions, you're tracking cash management, tracking baskets for the funds, you're tracking the portfolio, the performance expectations, and you're doing a lot of reconciliations. You're maintaining these relationships with your clients, your index providers, your custodians, fund accountants, market makers, fund administration teams, compliance, legal. The list doesn't stop. So it's a like I said, it's just a growing pile of information that you have to keep going with. And then that whole aspect of learning how to attribute what happened in a fund versus what happened in the index. So again, those being, those items and what that dictates it's going to sit around, is this fund functioning the way it's supposed to? And have you processed everything accordingly? So then that kind of I'll just say that summarizes what I did for the first couple of years at Penserra, really learning how to be a PM. A lot of my later time at this company, so in the last 2 years or so, has been, really learning what our clients need. The clients that I service are, they're not large asset managers, and they're not asset managers that launch S&P 500 funds. Why? Because an S&P 500 fund is not an expensive. The market out there for S&P 500 funds, the expense ratios are extremely low. So to be competitive, you need to have a lot of assets in that fund to actually generate revenue. So a lot of small issuers would never get into that space because they would never be able to compete against large asset managers who have billions of dollars in their S&P or Russell 2000 or large index-based products that exist. But what they do launch is thematic index products, niche alpha strategies that are out there, things that may be prevalent in the next 4 years that are not relevant yet. Things like online retail, things like 5G technology. These strategies that are developing are relevant because there's investor interest, but there's no large asset manager out there that's running a portfolio that targets that sector of the industry. That pretty much kind of summarizes my career in a nutshell. I'll say that the last thing is now a lot of my focus now has been on, developing new technology and new product or new processes that are, more risk efficient, more risk mitigating, more efficient. And that's just the way the industry is. So that kind of goes into a lot of my next advice, but I just wanted to leave that there. So we'll jump into a little bit of advice. And I'll try to keep it short here because I think it's not, a lot of it is very self-explanatory. But, first things first, education and GPA matter. I think you'll hear a lot of positives. You'll hear both sides of this argument, but I'll tell you that from my perspective, it's kind of like if you've ever taken the LSAT or some of the standardized tests where you get 200 points for putting your name on it, it's kind of like that. It's a very quick thing to not have on your resume as a high GPA and those things. But if you have it, nobody asks questions. So just something to consider. The second thing I have is finding a midpoint between overcommitment and expansive interest in the industry. And so what that really means is you don't have to become obsessed with your job, but you have to really enjoy it. I'll give you this little, just as an anecdote, I wouldn't be here on a Tuesday at 6 p.m. if I wasn't interested in what I do for a living. That's just one good example of it, because it's something that you find an interest in, you're overly committed to it, but not overly committed in the extent that it becomes obsessive. That's something to think about. The next one I have for you is diversify your learning. So for me personally, I always thought I wanted to do finance. I ended up becoming an accountant for the first 4 years of my life, which I didn't think was going to happen. In that job, I learned how to do some coding and a lot of operations experience. I don't have financial engineering experience, but that's something that I'd like to learn. So it not only diversify, but never stop. That's the other thing. I would say that it's very important to embrace the group learning opportunities in your career. You will find that in a room of a lot of people, there will be a subject matter expert, and learning from that person can gain you a lot. It can gain you a lot of steps forward that you wouldn't have, that may have taken a lot longer to gain. And so that's something to consider, is really understand who the subject matter experts are and ask a lot of questions to those people. The last two things, I kind of lump them together, but knowing your story and distinguishing yourself are kind of lumped in the same thing. I had a senior manager when I first started at State Street who sent an email to our group that said, distinguish yourself. And it was, you'll have, when you're still in school, your applications, and they'll have your resume, but you'll be the one who paints a picture. So be able to paint a picture of your life and explain, why things went the way they are and how you're working through them. And then from a career perspective, the things that I stand by are be prepared to know very little at first, and listen and learn and become proficient, then improve the process. Those two things are very connected also in the fund industry, because mutual funds, ETFs, those product types and that kind of investing is not taught in college. And if it is, it's taught as a very late elective in a finance major or something along those lines. So it's not something that you gain a lot of experience other than, why do people invest in mutual funds? Because they're diversified. You don't really gain a lot beyond those things. But very early on, you will learn a lot, and it's about repetition and constantly running those reps. And then the next one, I guess, within the listen and learn, become proficient, and improve the process. I'm of the learn the process. So I'm giving you numbers. Learn the process, mimic the process, and then improve the process. So those are the three things that I would say. We've had new hires come onto my team across the last 10 years who have, there is the, what do you want to hear from someone? Absolutely. I want to hear someone say, I'm going to come in day one and start improving everything for you. Absolutely. I want to hear that. But there is a sense of reality from how much does that person know to improve the process? Because in reality, a lot of people that you're going to be reporting to early on in your career have sat in your seat, have done that job. So learn, for there is a slight assumption there that they haven't spent that time to improve it. So I do say take the step in, really learn that. Don't hesitate to say I want to try to improve processes, but learn that they're be able to listen and learn first before you jump to that conclusion, basically. And then the next things I have on here, there's a caution that you really never want to say I don't have time, or that's above my pay grade. And when you're asking questions, have possible solutions. The reality of a career and working in financial services is the networking is key, because the industry is small. You're going to keep running into people that you didn't expect to run into again. You're going to want to distinguish yourself, because when you run into that person, you're going to want them to remember who you are. And you're going to want to know your job in and out, know your business in and out, and know it in its entirety. And one key thing there is, when I say in its entirety, you may not have the answer, but you do know who might have the answer or where to go to find the answer. So that's another level of it, is you don't have to necessarily know everything, but you need to know your business in entirety, where you know who can help you get to the solution you or your client is looking for. So let's see. I'll jump into the next slide, which is a little bit about Penserra. So we are a certified minority-owned business with offices out of Penserra, out of the Bay Area, New York, and Chicago. We have satellite offices in some other cities, but those are the three major places. We have 6 service lines that I've put in here: global equity trading, fixed income, equity exchange, investment banking, portfolio solutions, and ETF sub-advising. I work on the ETF sub-advisory team. The firm was started in 2009, and just you guys can see this, but we've got a lot of seasoned individuals from very large players in the industry. That was one of the key reasons why I went to Penserra, was the people I would be working with are large. They understood the industry. They came from large shops. They got a good whole holistic picture of the industry, and they were going to be able to help me progress in my career. Jump to the next slide, which is the ETF ecosystem. So this is kind of where I wanted to start. And there's a few things I want to point out in this diagram. The way that I want you all to look at it is a few things. So when I say where have I been, I have been in this the fund administrator, accounting, custodian block. Now, that section below ETF issuer is, those are the primary functions that I've been in. And then if you move up to the right of the ETF issuer in this investment management sub-advisor, that's where I am now. And why this diagram matters is, it has to do with that know your story conversation and understanding your skill set. So one of the things that I've had in conversation with Michael and with other TSS junior board and TSS students is, you know your skill set better than anybody else. If you're analytical, if you are operationally driven, if you're a rules-based person, if you have interest in sales, you can fall into different aspects of the ecosystem. And so that's why this is really an important image to see is, I sit in this little block, but there is a large ecosystem for ETFs that exists. And a lot of these companies are huge players, have tons of job openings, are constantly looking for new people, and are constantly innovating. And so you can join a PM team, you can join an operations team, you can be part of fund administration, tax, compliance. That's going to be a huge team, the auditing teams, lead market makers and broker dealers, sales and distribution of the fund itself. Marketing and PR for the product. If the fund itself is a new strategy that is investing in clean energy of some sort, or NFTs or blockchain or something that's out there that's a hot topic, and you understand the new age of marketing, whether that's social media or something else, you can land on one of those teams as well. So it's definitely a very, very large ecosystem. So I wanted you all to see that, to kind of see how it all fits together, and how it all makes sense, and to understand that the ecosystem can accommodate a variety of skill sets that don't have to all be, I know how to pick a stock. That's one way of thinking about it also. So the next thing I wanted to talk about a little bit more is more related to funds. So funds as a whole, so the way that my team functions within the fund industry is index-based passive ETFs. So index-based products have a very methodical way of running. They have a full rules based document that's called a methodology, and it follows a specific methodology, meaning when the fund rebalances, it rebalances on a specific schedule. When corporate actions happen, they're done in a specific way. So this document, some of these are going to be 30 to 100 page documents for index that will really specify exactly how to handle a specific event in a portfolio. And so I like to use the vehicle analogy because I think it helps understand what happens in a fund on a daily basis. So, if you go out to your car and turn it on and there's no dashboard lights on in the morning, for me, that's like when I log in the morning and all my positions in my portfolio tie out versus accounting, all the weights versus the index line up, the prior day performance looks good versus the index, the cash levels are all good, there's no failing trades or anything like that. Those are the daily checks that I would be running. Secondarily is going to be these ad hoc items. So, you have situations where a corporate action takes place in an index. A corporate action could be an acquisition of a company, could be a spin-off of a specific business unit of a company. A company could be offering additional shares of the company. Give me one second. Additional shares of the company, so that's equity offering. They can offer rights to purchase additional shares. So there's a plethora of different types of corporate actions that can take place. And so our job is going to be to really focus on it's going to be to really focus on how the index is interpreting that corporate action. Is the index, how is the index going to treat the spinoff? Is it going to be adding the spinoff? Is it going to be removing the spinoff? Is it going to be the company that was acquired by a new company? Is that new company part of the index? Is it going to be added? Is it going to be removed? There's a lot of questions that go into it, but that whole process is how the ad hoc items work. Then there's the scheduled items, and the scheduled items are things like quarterly rebalances, quarterly testing, semi-annual rebalances, weekly rebalances. The rebalance schedule can change depending on the strategy, but those are scheduled. So those are items that every week I know that a weekly rebalancing fund is going to be rebalancing, and I can prepare for that accordingly. So that's something another item to think about. Give me one second. I'm trying to catch up on these questions here. Yes, so we'll definitely jump into the ecosystem a little bit more as well. So going through.
Would you prefer that I hit you up with the questions as they come in? Because some of them are pretty relevant to what you're talking about at that point.
Yes, please. Yes, please.
Okay.
Yeah. I lost the Zoom bar actually went away, so I missed all the chats.
Okay. Well, I'll take care of that.
Okay, thank you.
You know what? I think here's a question right now that's probably germane to what you're talking about. Could you talk more about the major parts of the ETF ecosystem and also expand on what exactly is an ETF?
Yeah. Okay. So the ETF. So the ETF ecosystem and what exactly is an ETF. I'm going to get into that a little bit later.
Okay.
I will come back to that. So we will revisit that. I definitely have slides on that, so I'll touch on that later. Let's see. Okay, so we're through the vehicle analogy, and so let's go through some primary and additional functions. There's a really long list of stuff. So I kind of just, all I really did was throw all the things I do on a daily basis onto a piece of paper. That's what this is. So starting from there, I'm going to talk about it and kind of just explain the important parts of these. So, we've talked about fund accounting reconciliations. If those positions don't tie out, that means that if you needed 1 million shares to have 2% of exposure of a specific name in the fund and you have 500,000 shares, you're now holding 50%. So you're 50% of what you need. And so you're going to underperform, right? Or outperform, depending on how that moves. So that's just something to think about. You know, you need to match however you match, and that's the index. The key point there is the mandate of an index PM is to match an index. So you really need to just be lined up there. Custody differences are a little different because custody differences are the actual movement of shares. So what happens there is more real world issues, short positions. You know, if you sold shares you didn't have, that's a problem. If your trades are failing in specific markets where there's penalties, that's a problem. If you have buys of a specific currency that there's market fails for the FX, you're now going to have currency overdrafts. That's a problem. That's a problem. So those are kind of how the custody reckons. So they're more real world versus accounting problems. I've lumped together fund performance and index tracking. But basically those are done, one of them, fund performance is done on a daily basis. Index tracking is more of a monthly and quarterly process. But basically there you're looking for how did the fund perform versus the index? Is it accurate and is it within tolerance? If it's out of tolerance, is the performance difference actually valid? And then from there is if it's not valid, is that error correctable? And if it's not correctable, were there any transactions on that bad value, and do we need to make any shareholders whole? So one of the things that is key to portfolio management is understanding that the person you're trying to make whole is always the shareholder. You're always looking out for the shareholder's best interest above everything else. So you're always trying to make sure that you are doing everything to keep the shareholder's priority at the highest level. All right, and so the next thing in here is the corporate action portion, which I think I'm going to try to jump through pretty quickly because I did try to cover quite a bit of it. Things like cash dividends, things like equity offerings, rights offerings, spin-offs, mergers and acquisitions. It really does depend on understanding how the index is going to treat something. So I'm going to use mergers and acquisitions as an example because we recently saw an example in 3 of funds that my team manages. We're in 3 different instances. So in one situation, so the example I'm going to use is the acquisition of Slack by Salesforce. In 3 different indices, we saw Slack get removed completely. We saw the shares of Slack get converted into the shares of Salesforce. And then on the other side, we saw Salesforce be kept and Slack be removed. So 3 different completely different ways of understanding how the index is going to treat it and why. Well, one of them, it's because the technology that the index is invested in, it was invested in what Slack was using, but Salesforce doesn't have that. So it didn't want to have that Salesforce exposure. So there's really this understanding of implementation and why it matters, and how to implement it correctly. The next, oops, didn't mean to do that, sorry. The next thing I have on there is active fund management. And so that's an implementation strategy. So my team has 7 funds that are quote unquote considered active products. So there is an active manager, there is no index. But what happens in that situation is really simple. We work with clients that have a sub-advisor that is a strategy sub-advisor, and we have our team that's an implementation sub-advisor in that specific function. So basically, we have, for example, an actively managed covered call strategy. So what that is selling options against equity positions, and we get instruction from the strategy manager on the calls and on the positions he wants to trade. Our job as an implementation manager is to make sure that ETF is actually fitting within the rules that are the ETF vehicle rules. Those are things like IRS rules, SEC rules, diversification rules, things like that that they're not included in the normal calculation that a strategy manager might be looking to approach. The next thing I have in here is domestic cash balances and foreign cash balances. I touched on that a little bit, but basically funds have a base value currency that it's going to be valued at. And as you get into international products that have, expanded across multiple markets and are exposed to currencies, multiple markets, multiple currencies, and multiple FX rates, you now have to look at understanding, has everything settled? Is everything is the cash brought back to USD? Are you facing any FX exposure risk? These are the kind of the portfolio management issues that if you don't get those corrected, you now will have index tracking error because there was something wrong in the portfolio itself. The next thing I have on there is trade impact analysis. So within funds, there's going to be a trading benchmark for the most part. When you have an index will set a benchmark for any market or any index changes that it wants to do. So for example, when a fund rebalances, it picks an effective date on the close that it wants to rebalance. And then effectively in the morning, the new fund with the new shares will now perform the way you expect. Now that's a really complicated concept to process if you don't have experience with trading, but it has to do with the concept of dark pools and MOC, market on close trading, and understanding that there's a lot of liquidity at the market close that allows trading to happen that doesn't impact the true market price. So what that does is basically, in a given portfolio or in a given strategy, if someone's trying to sell a holding that is very, very large, but sometimes people are selling holdings because they don't want them anymore for X, Y, and Z fundamental or technical reasons. But within an ETF and within an index-based product, you may delete a holding out of the fund just for the sheer reason that it doesn't fit anymore. There's nothing wrong with the company. There's nothing wrong with the investment, the company's fundamentals, technicals, nothing wrong with it. Just this company no longer fits in the index method, the rules of this index. Now, what that does is it can create a huge imbalance in the trading of the name. So we then have to look and understand what was the impact of us trading that name. Now, versus benchmarks of the close, sometimes there's not enough liquidity on the close. So you may need to trade early, you may need to trade over a couple days, and that kind of trading does create performance differences. So we then need to understand what that difference was versus the index, so we can then have that proof for the board members and for the clients as a whole. And then I've lumped together pre-trade and post-trade at final in my notes. But basically, that's just client interaction. That's going to be, summaries to clients, explaining what transaction costs occurred, what happened in the process. Midday, the market moved X, Y, and Z. The names that we were trying to, some current event happened. There's a lot of reasons as to why a fund can move, a trade can move the way it does. All right. So then the left side of the screen is basically the primary functions. I included things on the right side just to kind of understand, like, when you work within a smaller team, this is kind of what is going to differentiate where I work and my team versus some of the larger players. A lot of these specific items can be siloed out when you work at a larger firm. At a smaller firm, we tend to take on quite a bit of it because we're not managing as much, and we are managing in a more hands-on way where we don't have the size to be siloed out. So I included these side functions as things that are add-ons, and this is kind of additional things that are included. But basically, when earlier I had mentioned, earlier I had mentioned things like trade settlement issues and trade currency issues, things like opening custody accounts in new markets, setting up FX instructions when in those new markets. So when the fund decides to buy, say, shares of a company in Japan, the FXs are in place to convert that US dollar to Japanese yen and back and forth, and for whatever reason, right? So that kind of stuff is a necessary setup thing, but that's also another additional function there. So I lumped that into trade settlements and trade currencies. There's in here, I've got quarterly testing, quarterly diversification testing, tax impact analysis. The way that stuff kind of lumps together is funds, ETFs as a whole, you're looking at the tax position of the fund because the way that taxing works within funds is you're looking to harvest losses, so you're not paying out capital gains. That's just kind of part of the process. And the next part of that is going to be basically keeping the portfolio within what's called quarterly diversification tests, and those are IRS tests. So basically, they've set these rules in place, and I'll give you the short version, but the 1940 Act is what's it called? The investment. It's called the 40 Act, but basically it's the Investment Management Act of 1940, I believe is what it's called. That is the where you're going to find a lot of the rules that were put in place for mutual funds to ensure shareholder safety. Okay, so what that means is basically, oh, I launched a mutual fund. It only holds Amazon. That's not really a mutual fund, right? That's just holding Amazon and paying somebody a management fee. That's not really the same thing. But within these IRS rules, it's things like the top, all the names over 5% of the portfolio cannot equal 50% of the portfolio. That's a 550 diversification test. Sometimes that can go down to 525 depending on the rules of the index. There's ownership limits for certain names. Things like if the fund is an owner of other funds, it can't hold over a certain percentage of those funds. It can't be an owner of the fund as the other fund as an entity over a certain percentage. There are rules like the fund cannot be invested over 5% in registered investment companies like broker dealers and things like that. So there's a lot of these rules that kind of keep it in place and keep it going. So I wanted to keep those in there. There's the top two items are portfolio management related. So I called it investment review committee. That's that performance, that fund performance and index tracking on a quarterly basis and a monthly basis. That's what that is. And on a quarterly basis, 13F filings are the SEC filings for your fund's holdings. They don't really apply as much with the index and ETF space because ETFs are published daily and index-based, that information is very public. 13F filings exist. We have to publish them, but they exist more for the hedge fund space and for active managers so people can see what they're investing in. And then lastly, I put in some business development related things. So new fund pre-launch analysis and new fund setup. So, new fund pre-launch analysis is something where a client really brings an idea to us and we look at it for feasibility and investability and where the limitations may come into place. So, things like market risk, things like, do we have all the setups in place? If you're going to be trading, what kind of assets will you be trading? Are we registered to trade in those asset types? Do we have the facilities to trade those asset types? When the fund idea gets to a certain point, is there going to be issues with liquidity or AUM, or is there going to be an issue with the fund as a whole in terms of day-to-day setup? So those are just questions that we try to forecast what this fund would look like at certain sizes. And later on, I actually have an industry problem kind of question or example for you guys that'll kind of explain more of that, what that AUM liquidity thing really looks like. But yeah, so then the next one is the pre-launch setups, and the pre-launch setups is basically like the simple version is, okay, a client has decided that based on all the information we've provided and all the information that they've picked up in terms of client demand or investor demand, they want to launch a specific fund. We go through the entire process start to finish. So that's going to be, setups with the fund accountants, the custodians, the transfer agents, the broker dealers, the lead market makers, everybody that's in that ecosystem. We're going to be on calls getting everything set up for those things. So that's a big part of what we do is really getting the ETF off the ground. And so here's where we're going to go into a little bit more about the ecosystem and ETFs and why they matter. So just for the person who was asking earlier, the question, so the point here that I'm trying to make for why does all that matter? So one of the things there is going to be, I've got some points here, clients are going to be out there marketing their ETFs to prospective investors as a product that fully replicates that index and as a product that will gain them maximum exposure to that index. And their gain is to essentially gain, or their aim is to gain assets into that fund, which they will then make money off of with the expense ratios, right? That's the goal. And so ETFs have grown in popularity, right? Over the last 5 years, they've become such a large player in the investment management space for specific reasons. But the key here is all this matters, all those items that I mentioned and the primary functions and the additional functions, those items matter because when an issuer goes to sell this fund, if they're selling it to a wealth manager or a pension plan that says this fund is going to give you exposure into specific clean energy, call it hydrogen energy, right? So say that this strategy is going to gain exposure into hydrogen energy. If and say the index was up 50% this year, if the fund was only up 40 and we couldn't explain it, that would look very bad from our perspective. So if you think about it that way, it's this understanding that we're trying to keep the strategy along the same performance replicated to the index, regardless of whether the index went up or down. We're still trying to do the same thing as the index so that our clients who have created these strategies can go and sell them accordingly. Key things to think about there are going to be, why one thing to remember is nobody buys ETFs, somebody sells them. That's one thing that you'll hear quite a few times in this industry. What are they selling? They're selling a fund that fully replicates the index, or an active strategy that fully replicates that active strategy from that strategy manager. They've created an investment case or an investment thesis for this product, and our mandate is to track the index that they've created. So whether that's the strategy manager or the index, our goal is to replicate that performance that they were hoping for. So the next slide I have is a little bit more about these investment strategies. And so, thinking objectively and high level, what goes into creating the strategies and why they exist. So issuers tend to be diversified across quite a few different types of strategies because, what happens is in a very risk averse moment in the market, you might find a lot of money invested in disruptive technology or in growth space or strategies that are strategies that are high risk, right? But say there's a huge change in market sentiment and all that money rolls into income or fixed income based products or strategies that are high yields and low risk, and it's all going to roll depending on where that industry is. So a lot of these issuers, they really want to develop a lineup of funds that is kind of broad based, so that say the money does come out of the growth space, it goes into the income space. Well, they actually had assets in both, so they're able to maintain their business, right? That's the goal there. And I can say that from my perspective, so I've been part of 60 plus fund launches now, and I've also seen 20 funds or 20-ish, give or take, have liquidated. So one of the things that I'll say is, not everything has the sentiment that the investor sentiment that they thought they were going to get. But that doesn't necessarily mean that it was a bad idea. Sometimes it's just timing, right? That ends up being part of it. And the reality is level of risk is key. The time horizon is important. The sector growth expectations are key. And then true market conditions and understanding market strategy and where it all fits in. So these are just kind of some of the strategies that I manage. I wanted to kind of keep them in here to understand how they diversify. These income products are going to be very, very, very low risk. These disruptive spaces, we can watch them swing 10 to 20% a month. So it's very, and I mean, then when you get into things like cannabis, it can be even more than that. So it's way beyond the scope of movement of the index is very large. All right, so the next thing is going to be in the ETF space. So I apologize if this looks a little blurry. The reason I wanted this tab, so this is going to answer that question more about ETFs and why why they've gained popularity. But I really want to touch on a few things here that really point to where ETFs have gained their popularity. One of the big ones is going to be the top point, which is buying and selling and intraday trading. The ETFs have gained a lot of traction in the industry based on the fact that I would say it really is related to the fact that news and information moves so quickly. We've seen, when you buy a mutual fund, if you weren't aware of this, mutual funds, when you make a contribution to a mutual fund, you transact on the day ends NAV, and the assets that are that go into the fund, the portfolio manager then buys the underlying assets the next day. So there's a very time delayed situation there, while ETFs can be bought and sold intraday, right? So the reality there is I'm going to jump down a little bit, but there is that minimum investment space also. You can, with an ETF, not only can you decide immediately you want exposure into that space, but also how much exposure you want. So there's a almost immediate aspect to ETFs that have gained that helped them gain that traction. The next thing there is the holdings part of it, right? So I talked about how ETFs are published daily. Mutual funds aren't published daily. They're actually published month end and sometimes even not published, sometimes quarterly. So that ends up adding another aspect to it, where if you wanted to invest in a mutual fund that had exposure to a specific industry, but you didn't believe, you actually believed that there was a specific name in that industry that you didn't want access to, you wouldn't know if the mutual fund had bought it until possibly the end of the month, maybe the end of the quarter. While in an ETF, you would see it on a daily basis. If any of you are familiar with a lot of the noise that in the news these days with Cathie Wood's funds and the ARK funds, you'll see that a lot of people, they're constantly talking about ARK bought this or ARK sold this, and that's because that information gets published daily. So people are way more, the information is shared much faster. The next thing I want to point out on the ETFs is this understanding of trading transparency and the trading costs associated, and then the tax efficiency. So, the ETFs themselves are inherently have inherently been cheaper. They've launched at cheaper expense ratios since most of them have been inception. And I think one important thing to realize is that that when you're charging less, it's going to attract assets regardless. But also understanding that you're not paying a lot of the underlying costs related to an ETF management, so versus a mutual fund. So that when you contribute to a mutual fund, you're contributing cash. The portfolio manager then goes and buys the underlying securities. Well, when you bought an ETF, you bought shares of an ETF that the ETF already had the underlying shares. There's no trading involved in that. It's just you buying a share of the ETF and you selling that share of the ETF. And it has to do with this whole lead market maker and authorized participant process, where they create shares of the ETF for you so you can buy and sell them without making cash contributions to a fund. It has to do with the way the ETF vehicle works. And then the last part of this tab that I think is worth mentioning is there's a process called a market trade and an in-kind trade. So a market trade happens on an exchange, and a market trade, everything, the repercussions of the market trade are, there's a true tax implication of a market trade. When you trade in kind, what's happening is it's a movement of shares from one party to another party with no exchange involved. So there's no market trade. So there's no tax implications there. What this means in the grand scheme of everything, and it would be a very, very I'll say tedious process to try to explain it, because I can tell you that I have new hires that I try to train this on. It does take a couple months to really get used to how this in-kind process works. But what it does is it allows the ETF vehicle an opportunity to remove shares of underlying names, say Zoom or Apple or somebody that's done really well during the pandemic. Say the index wanted to delete it, but that name itself was going to generate large capital gains into the fund. The in-kind transaction gives the fund the ability to remove those shares from the fund without actually market selling them and without generating a taxable event. That's the key there. That's the key there. And so it's the taxable event is the key, and it's one of the primary reasons why ETFs have gained a lot of traction, because the investors that are buying the ETFs, not only are they, so summarizing, they're able to buy it when they want to, so they're not missing out on the time delay of news. They're able to make the investment size that they want to. They don't have to put in a minimum. They can drop it in. They can buy one share. They can buy 1 million shares, depending on whatever they want. And they can do it at a tax efficient way. So there's definitely a key there that's important.
And I think I've got a question here that Just
Gotcha.
kind of germane to what you were just talking about.
Okay.
The question is, and I'm assuming this is ARC Fund, which tracks Kathy Wood's exact investment strategy in terms of a security. Does your firm also make such ETFs slash
Yeah.
funds which
Yeah.
replicate someone's specific investment strategy?
So we don't, so what we work in a very unique space where we're what is considered, the way ETF sub-advisory is considered, we're portfolio management for hire. That's the easy way to explain it. What happens is these companies that want to launch the product are better at selling it and better at actually marketing it. And my team that I work with are all seasoned, experienced PMs when it comes to implementation. So we work in that space. But yes, we do have funds that replicate a specific strategy. So the 7 funds that I've mentioned that are active, we do manage in a very specific way for those. And what it is, basically, there's a strategy manager similar to a Kathy Wood who tells us we want to buy, we want to sell, we want to do something in a specific way, and we will then take their ending portfolio, what they wanted to buy or sell, and really look at it and make sure that it fits within the ETF vehicle. And when I say fits within the vehicle, that's when you're talking about all the legal compliance, the rules, the exchange rules, and all those items.
Okay, Anand, I'm gonna knock some of these out. You only,
Yeah. Nope, sounds
okay,
good. I have one slide left anyway, so we can.
okay. Well, let me just ask these.
Yeah.
What's critical technical skills do you think a junior or senior student needs to prepare to take a foot into the portfolio management career, like equity valuation, portfolio modeling, risk modeling, risk modeling, or any certificate?
So that's a really good question, and I think it does pertain to one of the nuances within the title portfolio manager, because I can tell you that if you worked on my team, you may not be doing any of those 3 items, whether it was equity valuation, modeling, you might not be doing any of those things. But then again, if you worked at a hedge fund or a Kingsford for that matter, or something like that, you will be doing all of those things. It really depends on what kind of portfolio manager you are. From my perspective, I'm a index implementation PM, so it's a lot different than understanding whether this company is going to be growing at this rate or modeling its growth or any of those items. I'm not going to be doing that. I'm going to be given a set of investment instructions, and I'm going to make sure that the portfolio that I'm running is actually tracking to that and basically monitoring for any bumps in the road. So so I think depending on what kind of research you want, what kind of ending role you want, all of those things will prove beneficial. They just might not be in the same function. So if you were more on the active ETF side or on the active hedge fund side, then yes, definitely. Sorry, not the active hedge fund side, the hedge fund side, the active management side, the active asset management side, yes. And the index-based side, you might not use any of those things. Seeing another question in here, what's your advice to a student who wants to crack into buy-side finance lines, such as private equity or hedge funds? A lot of those, from my perspective and for the people I know that have gotten into those, it's really going to be a few different things. I've seen a few different avenues. The networking aspect is key. I think that doesn't go away. The skill set aspect of it is really important. And then there's also the sector specific stuff. So if you wanted to get into private equity, but what kind of private equity, right? So if you wanted to do private equity that focused in tech companies, I would hope you have a good software or hardware or engineering background to get into that, because the true understanding of the business modeling is going to be great. But I would also make sure that you had the skill set to apply that to what the real world really looks at, right? So an example, a tech company that says that future growth is 25% because the total addressable market is 10 billion people. There's not 10 billion people on the planet. So that's where you would have to logically understand and go, no, that doesn't make sense. And if it's a tech company, half this first portion of the population doesn't have the internet. Like there's that, I guess, realizing that real aspect of it that I think is important. So to summarize, networking, I think, is one of the key points there. Finding a mentor in that space is probably going to help leaps and bounds, and truly understanding what you can do to distinguish yourself versus other applicants in the PE or venture or banking space. I'll give you guys this last example really quick, just because I have it open. So I wanted to do a really quick understanding of what that, when I was talking about scale and why that matters. So this got a little condensed, but basically this right column is supposed to represent a $1 billion fund. And this left column is supposed to represent the number of names in the fund. And I just calculated it based on an equal weight index. So just looking at if a fund had 25 names in it and they were equal weight, they'd all be 4%, obviously. If the fund was $1 billion, it would be 40 million per name, right? Just easy math. But one thing to realize is this is part of the reason I'm bringing this up is as a realization. One industry problem is scaling new investments, right? So one thing that happens in the industry is, you're looking to be first to market with a product that has investor interest and is going to gain assets. But what if those assets are gained too fast, right? What if they come into the fund too quickly? So take $1 billion fund, right? So one of my clients launched a fund that was very recently that focused on big data, right? Now, if that fund, if it became $1 billion by the end of the year, the underlying names, the average market cap of the underlying names is $18 billion. So for us to buy $40 million worth of shares is less than 0.25%. No issue, no problem. Probably don't find it. No, there would be zero liquidity issues, right? But now take another example. Let's look at cannabis, psychedelics. That's another industry that this same client launched a product in. If you calculated that same row, so basically if that product became $1 billion fund with equal weight, talking $40 million in companies that have an average market cap of 600 million. So we're looking to buy almost 7% of the company. That's where you start looking at these scale issues, is at what point does this fund become too big and actually start having problems in terms of liquidity and trading, and will the trades take multiple days? And that's kind of where I wanted to go with that. All right, Michael, that's all I've got for today.
That's it. Okay.